Greetings, everyone. I'm David Darst, here to give you a recap of financial market and economic developments in the second quarter and, of course, for the first half. There have been a number of surprises. I think many of us were expecting things to be different than they've turned out. You've had China's recovery has been very feeble and weak and underperforming. You've had the fallout from the failure of Signature Bank, of Silicon Valley Bank, of First Republic Bank has been modest. It has really not been it has not created a panic. You've had a number of peace discussions between Iran and Saudi Arabia. You've had Saudi Arabia and Russia elect to cut back on their output somewhat. You've had weakness in oil prices and in food prices. You've had the Bitcoin. Bitcoin was down significantly last year, and it's up over 70% so far this year. So in the realm of currencies, you've had the Chinese renminbi and the Japanese yen have been weak. And believe it or not, the Colombian peso, the Mexican peso, and the Brazilian real have been strong. So there have been quite a number of surprises. I think the second quarter has been a basically continuation, and this would be the biggest surprise of all, has been the tremendous enthusiasm for artificial intelligence-related equities. You've had the Big Seven have accounted for such an enormous part or contribution of the S&P 500's gain thus far this year, 15%. 70% of it has been these seven stocks, and you know which ones they are. And they're 35 to 45% would be Apple, would be Amazon, would be Microsoft, and of course Google, which is called Alphabet now. But the other three stocks, and they all end in the letter A, and that would be Nvidia, that would be Tesla, and of course that would be Meta, which is the old Facebook. And they're up, all of them, over 100%. They've doubled. And our friend Nvidia, because of this enthusiasm for the chips that facilitate and create this ability to mine data and the internet to create text, to create images, it's almost tripled thus far this year. China remains in somewhat of a deflationary mode as far as inflation, and in the United States, inflation is coming down. It does remain elevated in the United Kingdom and in, of course, Europe. As a result, you have the Fed basically is talking about maybe one more increase, maybe two more increases, all right? But they've had quite a bit of monetary tightening, and we don't think it has fully kicked in just yet. At the same time, you have the Chinese central bank seeking to stimulate, not to restrict. You have the Bank of England. You have the European Central Bank. You have the Bank of Canada. You have the Reserve Bank of Australia. All of them are remaining in tightening mode. You have I think another surprise this year is the delayed recession. Everybody was talking about a recession in the first half of this year, and it really has not come to pass. The first quarter GDP number for the United States was plus 2%. The earlier estimate was plus 1.3%, now plus 2%. Early look at the second quarter, which has just ended, as you know, the early look is for maybe 2.1%. So 2 quarters back to back of a couple of percent growth, which I think has been quite surprising to people. The economy is slowing, however. It is slowing. You're seeing some degree of tightness releasing in the labor market. We'll see more about that as we get more jobs numbers. But the early July number, which was for June, as you know, showed only 208,000, something like that, jobs created. There's been, I think, slowing going on in the consumer, slowing in business capital investment, and we see bankruptcies have begun to appear on the horizon. It hasn't spiked to a very, very large level yet, but bankruptcies are beginning to appear. And that leads us to one of our investment thoughts. You've got to expect spreads. That's the difference between treasuries and conventional corporate bonds. You've got to see those spreads widen, okay, as people look to buy treasuries for their safety, as they reduce their exposure to high yield or some somewhat suspect credit obligations. Let me just say the leading economic indicators have been down 14 months in a row, and they have almost, nothing's perfect, but they have an almost perfect record in terms of predicting or foretelling a recession. The other thing is the inverted yield curve. We've talked about this many times as part of this communication with you. And the yield curve is currently maybe minus 85 basis points. It's inverted 85 basis points between the 10-year and the 2-year. The 10-year should be above the 2-year, but no, it's below the 2-year by about 85 basis points. It's been even further. And that also has an almost perfect record in predicting a recession. I would say, whereas the lead indicators have almost a 95% prediction success rate, the inverted yield curve has something like an 85%. But still, we've had this very, very heavily inverted yield curve. And the third thing that makes us a little bit cautious as we enter the second half of the year, and we may avoid a recession in 2023, and it may come more in 2024, because don't forget, the Fed has raised interest rates at one of the fastest levels, one of the sharpest rates of increase in history, going back to the 1913 founding of the Federal Reserve. This raise of interest rates has been very, very dramatic, and it has a long lead time and lagged effect to where it affects the economy. So we're expecting that, along with the inverted yield curve, along with the leading economic indicators, to portend a slowdown. So we think we had a soft landing in the first half of this year. It's been a soft landing, or maybe no landing, all right? But as we enter the second half, we'll be looking at its effect on corporate earnings. Now, this brings us down to what's the implication for you as you think about your financial assets, as you think about your portfolio. First, we think we would want to see private credit. We think private credit can give some generous returns. You want to make sure you're at a good place in the capital structure. The second would be private equity. Now, private equity, you see many partnerships. People would like out of their private equity. So valuations have come down in that area, and that's also to us an attractive place to be thinking about allocating some capital. Real estate credit is another one, because there's been this huge amount of publicity after the Silicon Valley Bank Corp and the Signature Bank and the First Republic Bank problems. People worrying about the real estate offices. People are not returning to work the way they were pre-pandemic. And there's some pressure on commercial real estate. And so we think if you pick and choose and you're very selective in your areas, and in your areas not only geographic areas, but your area of the capital structure that you're focusing on, this would be another one that we would want you to have thinking about exposure to. Finally, in the equity market, liquid equity markets, volatility is low in equities. That indicates a lot of complacency to us. Whereas volatility, the MOVE index, which is the VIX index for bonds, is quite elevated. So we would use this as an opportunity to be very selective in any liquid market equities that you're getting exposure to. Growth has been the big name of the game for the first half. No problem with beginning. It could continue to run, no question. But no problem with beginning to basically diversify out a little bit from the growth into the value and the defensive sectors. We have no problem owning some of these. It does seem to be broadening out a little bit into places that are more defensive. You're talking about healthcare, okay? You're talking about consumer staples. They've lagged way behind No problem continuing with some of the growth, but it's time, I think, to basically become a little bit more diversified in the liquid markets. With that, we thank you for being with us today, and we wish you a great start to the second half of 2023.